Morning, everybody. So you heard from Chris a little bit earlier today talking about our investment principles that really guide every investment decision that we make. I wanted to go a little bit deeper and apply that theory into some practical examples, give you a bit of an update on some of the investment themes that have been in our portfolios over the last little while, and to share with you some of the opportunities that we find really interesting at the moment and have gone into the portfolios in recent months. But before we do that, it's helpful to have a look at the current investment environment, and you guys might be picking up on some of these themes coming through from your clients. It's certainly been a particularly volatile period. If I call out a couple of those, Brexit is the one that springs to mind. We're getting very close to that March 29 deadline of the Brexit outcome. Obviously, trade wars dominated much of 2018 with a perception that the US was best positioned to weather those trade wars, and some of the other more emerging economies will be more adversely affected. And obviously, ongoing uncertainty around the direction of US interest rates. But as Daniel highlighted in his presentation, these are very, very important issues, but they are generally unknowable. It's extremely difficult to predict the outcome of these events. And even if you had a feeling, you were able to predict the outcome, it doesn't in itself lead to an investment decision. So the way that we approach these situations, and a way that's proven much more effective in guiding or predicting future returns, is to understand what our valuation analysis is telling us. Are you getting a good deal in markets, or are you not? Have you paid too much? And I suggest to you that markets are going to react very differently to these sorts of events if your starting point is expensive versus something like a GFC type scenario where markets are cheap and sentiment is awful. Now, the valuation-driven process that we're sharing with you today now has 9 years of track record, and you can see on this timeline here a range of the investment themes that have come in and out of the portfolio over that timeline. And I wanted to start with a refresh of our view around Japanese shares. So we've had a positive view on Japanese shares now for 8 years. It really evolved in the wake of the Fukushima disaster. And obviously there's an enormous humanitarian cost with that disaster and natural disasters generally. But what you also typically find is that the economy slows, sentiment towards the share market is weaker. And that was certainly the case for Japanese equities. So this is a simple chart showing the value of $10,000 invested in Japanese shares 2011 through till December 2018. And it's actually been a pretty good period for markets. When we did our analysis here and we saw Japanese shares created a valuation opportunity, our immediate investment was a 3% weighting to Japanese shares in the growth bucket of our portfolio. We went away, we did our work, trying to understand the cash flows in Japanese corporates. And what we felt is that investors in Japanese shares were actually extrapolating what had been a pretty dire preceding 2 decades, and they were extrapolating that forward as being a reasonable expectation of the outlook for Japanese shares. But we felt that with only a modest assumption around improving profitability for Japanese shares, that they represented compelling value. The other thing that's going on in Japanese shares at the moment, around 2012, as a courtesy of, as a consequence of the Abenomics program, is there's structural change. And really what that's about is a focus on Japanese corporates to really deliver improved shareholder outcomes. And one of the ways that we can look at this is in relation to this chart, which shows how many independent directors, or the percentage of Japanese corporates that have 2 or more independent directors on their board. And that's really important because having independence on the board should lead to improved allocation of capital. And we can see here that the levels were quite low 2010 through to 2015, but they've really lifted up in recent times. In our portfolios, we actually have an allocation to the Nikkei 400 index, and it's specifically constructed to identify those companies that have greater independence on their board. The figure's actually 97% for that particular index. So the obvious question then is, we can see that Japanese shares have done quite well. Some of the fundamental themes that we like appear to be playing out. Does that mean that the thesis around Japanese shares is pretty much coming to an end? I'll answer that question in just a moment. Some of you may have seen this chart before. We produce it as part of our quarterly outlook and perspective document. And it shows the expected returns after inflation for a range of growth assets. The red shows the expected returns as at December 2018, and the tealy colour is that same figure but December 2017. Where the red bar is higher than the teal, it means that expected returns have improved over the year. Why is that? The shares have fallen. And if you think about December 2017 was actually a pretty strong year for growth assets. 2018, much more volatile, and particularly that final quarter where we saw a lot of weakness in global equity markets. So we can see much better value now. But to Daniel's point before, this is not the environment to be aggressively adding to growth assets. These returns, and particularly these ones over here, are much below what we would consider fair. So coming back to Japanese shares, we can see it there. It's the fourth one in from the left-hand side. Expected returns in Japanese shares are actually quite strong. It remains among our preferred regions. The fundamental trends that I was referring to around improving profit margins, improving dividend payout, they are still in play. They are nowhere near the level of what we might see in US shares, for example. The difference is that the market isn't really valuing Japanese shares. We've seen, by contrast to the US, where we've seen quite a bit of multiple expansion over that time frame, we've not seen that in Japanese shares. So Japanese shares remain among our key opportunities. I just wanted to call out a couple of other ones here. The one second from the right is US shares. So again, as Daniel pointed out, the reward for risk in US shares is actually quite unattractive. Yes, it's better than it was this time last year. This time last year, we didn't even think that US shares would be able to keep pace with inflation, the returns from US shares. That's quite a strong statement. And while it's positive now, you can see that there's a lot of things to the left that give us a much more attractive reward for risk. The one that's second from the left, UK shares. So what's going on in the UK at the moment? Brexit. So again, we have no idea what the outcome of Brexit will be. But this expected return here suggests that you're getting reasonably well compensated for the range of Brexit outcomes. This one here is emerging markets and Asia in particular. So I will come back to emerging market shares. I do want to spend a little bit more time, but just remember the emerging markets also very prominent among our preferred regions here. If we have a look at defensive assets, it's actually not that good a picture either. A number of these bond markets over here, really the developed world bonds, we think are going to give negative expected returns. We don't think they're going to keep up with inflation. The risk of loss is quite significant. In fact, that one there in the middle, global aggregate bonds, it's effectively the market cap of bonds, if you like. Again, negative expected returns. Now that's a problem because bonds are the defensive part of your portfolio. But there's nothing defensive about holding an expensive asset. And if you cast your mind back to the Q4 volatility that we saw last year, there was a period of time where both shares and bonds were falling. That's not how it's supposed to happen in the textbooks. But it's how it happens in practice when your starting point of valuations is quite expensive. Again, where we can see opportunity is over here, emerging market bonds. And in fact, emerging market assets generally, again, this is a simple chart of investing in the MSCI Emerging Markets Index for the value of 10,000 over that time. And that period there is really that weakness over 2018. And what we saw is that, again, this is very much the trade wars playing out. Emerging market shares, currencies and bonds all saw weakness over that period. As you'll recall, though, we can still see quite strong expected returns. Our positive view around emerging market assets actually began around here, mid to late 2015. The catalyst for that was that China devalued their currency in August 2015 and again in 2016, early 2016. People took it that that's the end of the China story. But not only did Chinese equities fall, all of the neighbouring countries, Korea, Taiwan, Japan, also saw a lot of weakness at that period. If you like, the baby went out with the bathwater. But again, we can do our analysis on those companies and we can see quite attractive return profiles and quite high quality businesses. But our emerging market exposure is actually quite a bit different to the index. So the index would see is about 30% weighted to China, about 15% to South Korea, and about 12-13% to Taiwan. Collectively, they make up about just under 60% by their market cap. But you can see here, we have a much more positive view on Korea specifically. And by extension, Samsung. Samsung is quite a significant component of that market. Samsung's telling you that their earnings are under pressure. But when we look at what's in the price, we think that there is actually a valuation opportunity in that market. We hold quite a low weighting to China. Again, as I mentioned, it's there. As I mentioned, 30% in the index, only 13% for us. We can hold more Asian IT here, less financials. These are the levers that we can pull as asset allocators. So jumping forward now into some new themes. The greyed out lines here, they represent a range of sectors in Europe, so things like financials, energy, etc. I've greyed them out deliberately because I wanted to show you the evolution of our theme around European telecoms. So when we're talking about European telecoms, we're talking about companies like BT, Vodafone, Swisscom, Telefonica, Orange, very much household names certainly in Europe and I'd suggest in many parts around the world. And you can see there for a period kind of in the middle of the pack and more recently towards the end of 2017, really separated away. This period of here, a number of cyclical sectors like energy and financials actually performed quite well. Little old telecoms here got left behind. So the relative appeal certainly increased, but it increased in an absolute sense as well. Telecoms are showing much better valuations, and that's because there's quite a bit of risk around there at the moment. If we look at some of the risks for telecoms, the first is in European telecoms, you're unlikely to see much consolidation in that market. That means more competitors in a market, more pricing pressure, more risk to margins. But more broadly, telecommunications companies, they need to adapt their business model. We as consumers are changing. We don't use fixed line telephony much anymore. We have a huge appetite for data. And so those businesses, they need to adapt to accommodate our changing tastes. Now with it, that brings risks. They may go and splurge on media content in order to try and satisfy our demands. But to the question of what's in the price, we think a lot of it's actually being captured at the moment. You are being rewarded for the risks that those companies that they face. Daniel talked a lot about contrarianism in his presentation, and this slide gives us an indication of sentiment towards global telecoms. You can see here, it's genuinely a quite unloved asset. This is a big tick for us. When we can look at those cash flows, we can see the quality of those businesses, and we can see the fact that nobody else likes them. The other one I just wanted to call out on this chart is consumer staples. So when we're talking about consumer staples, we're talking about quite a defensive earnings profile for these companies. They're the sort of things, the supermarkets, the food and beverage producers, the household products. You're pushing your trolley down the Coles aisle. They're the things that are going in pretty much every week. We can see on this chart too that they're quite unloved. Not to the same extent as telecoms, but they're certainly out of favour. And if I share with you the expected return chart of consumer staples over time, you can see again, very much middle of the pack for a long time, but more recently those valuations have improved. We're getting a better deal in consumer staples than we were, and it certainly stands out compared to some of the other things on that chart. And so what's going on in consumer staples? Well, there's enormous competition, and we can use a local example here, Coles and Woolies. For a long time, they were earning above average margins, and then in comes Aldi with much more pricing power, and you're starting to see a reversion to more realistic margins over time. That thematic's actually playing out all around the world, if you think of the Costco's and the like. Now that brings with it some challenges for those traditional companies in the consumer staples sector. There's much greater focus now on private labels. Perhaps the importance of some of those big brands is a little bit diminished. If you think about some of the technologies, Amazon is really revolutionising how we can order our things online, the whole e-commerce space. But it's not just that. YouTube, you can have an advertising campaign go viral on YouTube. So the importance of the supermarkets as a distribution point has also potentially diminished. And then lastly, very much changing consumer taste. If you think about the Cokes and the Pepsis of the world, we know that that trend around fizzy drinks is very, very well pronounced. But again, when you ask yourself what is in the price and what is the advantage of these businesses, they have an incredible brand, an enormous distribution network with which they can release new product into. So what you find is that within this particular sector, these companies are actually very, very high quality in our view. And I'll share with you how Morningstar thinks about quality. So when we're talking about companies, we talk about a moat. If you are a company, how big is the moat around you to mean that your earnings are sustainable for a period of time? And so this chart shows the top 20 companies in the Global Consumer Staples ETF that's in the portfolios. And you'll recognise many of these names: Nestle, Procter & Gamble, Coke, Pepsi, Walmart, Unilever, etc. Very much household names. And what we can see there is that 17 of those companies in that top 20 are what we would consider wide moat, 2 narrow moat, and just 1 that doesn't have a moat. So let's try and put some numbers around that. For a narrow moat company, we think they'll earn above their cost of capital for 10 years or more. For a wide moat company, we think they'll earn above their cost of capital for 20 years or more. So in this example here, 17 of the 20 companies are wide moat. More than 91% of that market capitalisation is wide moat. 98% if I include these narrow moat companies here. So what we're saying is that the vast majority of this business, of this ETF, of the businesses here, we think are extremely high quality businesses. And if you think that they are going to be around for a long time, as we do, what you've got is the chance to temporarily buy these companies on sale. Yes, they have their headwinds, and it's affecting sentiment towards those assets right now. But we're happy to back management, happy for them to pull the levers that they need to pull to ensure that they are able to compete effectively moving forward. So in summary, to the question of bonds versus shares, actually we're cautious on both. We think that in many cases share markets are expensive, and certainly bond markets, as we've discussed. You need to hold more cash in your portfolios, in our view, to help preserve capital and to give you the dry powder when opportunities come available and you need to buy something. Within the share asset classes, less favourable on US and Australian shares, much more favourable on UK shares, emerging market shares and Japanese shares. Cast your mind back to that valuation chart. They were the assets that were on the left-hand side. Within bonds, struggling to see value within developed world bonds, with the exception there of shorter dated US Treasuries. Where we can continue to see a little bit of value is in emerging market bonds. So with that, I'm happy to open up to any questions you might have around portfolio positioning or anything else.
Any questions for Clint?
No?
We've got Lorenzo walking around with a microphone there, and I know Mega's on that side, if there's anything particular. Be quiet. Well, there's one in the corner, Mega.
Sure.
Hi. You mentioned that diversity is quite important, and I noticed there's no infrastructure, property, commodity analysis in your...
It's on this chart. I'll just bring it up for you. And we certainly value it. So listed infrastructure is here, is that one. Global listed property is here. And Aussie listed property is here. So relatively speaking, among the lower returning assets in that growth mix. And again, if you think about Daniel's chart like this, if you have something that's offering lower expected returns, your risk of loss is more significant as it goes back to its fairer value over time. So with our portfolios, we have relatively low weightings to those three.
Any more questions from anyone? Okay, well, Daniel and Clint will be around at morning tea, but Clint, thank you very much. It was sensational as ever.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.